In Week 6, we continue our study of liability and turn our attention to the important concept of lease financing and the liabilities that result from these transactional types. A lease is a contract that gives the lessee, i.e., the renter, the right to control the use of an asset for an agreed-upon period of time. The lessee pays the lessor, i.e., the owner, for that right to use the asset over the specified lease term. In addition to exploring the advantages of lease financing, we will examine accounting for leases from a historical and current context. Lease accounting was one of the major joint projects between FASB and IFB and resulted in a standard that has revolutionized lease accounting. This standard was released in early 2016, and most companies will be required to start utilizing this revised standard starting in 2019. As we begin a review of Chapter 15, our primary focus in the chapter presentation will be on the accounting impact from the perspective of the lessee. While it is important to understand the perspective of the lessor, particularly if you intend to work for a leasing company and/or intend to pursue the CPA exam, we believe that once you deeply understand from the perspective of the lessee, you will be in a strong position to explore the reciprocal side of the transaction, similar to bond accounting. If you have ever rented an apartment or leased a car, you know that a lease is a contractual arrangement by which a lessor provides the lessee the right to use an asset for a specified period of time. In return for this right, the lessee agrees to make periodic cash payments during the term of the lease. There are a multitude of advantages of a lease from both the perspective of the lessee and the lessor. From the lessee's perspective, there is often no down payment on many, but not all leases. Most leases offer fixed payments. They avoid the risk of ownership and specifically protect against obsolescence. They have added flexibility in terms of the duration of the lease term and the payment options. And prior to the implementation of the new lease accounting standard, there were previous financial reporting advantages deemed off-balance sheet financing. From the lessor's perspective, there are increased sales opportunities resulting from the underlying advantages to the lessee. There is the potential for an additional revenue stream in the form of interest revenue. There is an ongoing business relationship with the customer, and in many cases, there is a substantial residual or leftover value that's retained by the lessor, allowing the property to be leased again or sold at a profit at the end of the lease term. As we continue to set the context, it's important for us to have a perspective prior to the 2016 new lease accounting standard of the leasing treatment. From a lessee's perspective, there were two types of leases, the first being capital and the second being operating. It's important to note that leases encompass nearly every corner of business today, whether it be the tires on a bus, buildings, housing, or manufacturing lines. From the current accounting model for leases, there are two treatments, and the two treatments had a significant differentiating effect on the financial statement impact. As we explore the criteria for a capital lease, FASB historically classified a lease as a capital lease if one or more of the following criteria were met. The four criteria are as follows. First, the lease transfers ownership to the lessee at the end of the lease term. The second, the lease contains an option by which the lessee can purchase the leased property at a price sufficiently lower than the expected fair value at the end of the term, often deemed a bargain purchase option. Third, the term of the lease is equal to or greater than 75% of the estimated economic life of the leased property or 75% of the useful life of the property. Fourth and final, the present value of the minimum lease payments made by the lessee is equal to or greater than 90% of the fair market value of the leased property at the inception of the lease. Before we explore the current context, let's take a step back to explore accounting for leases prior to the release of the new standard. Under an operating lease, no effective transfer of ownership has taken place with the underlying lease agreement. The lessee would account for this by recognizing periodic rental expenses with no asset or liability appearing on the balance sheet. Under a capital lease, substance over form would dictate an effective transfer of ownership of the underlying property based on one or more of the four criteria having been met. On the signing of the lease, the lessee would recognize the value of the asset and the liability for future lease payments on the balance sheet. Now that you have some real-world context setting for the need and the importance of the new lease standard, I want us to explore the lease project timeline. The leasing project started in 2005 with an issue brought to light by the Securities and Exchange Commission with a report called the Off-Balance Sheet Report. The project was then initiated in 2006 by the Finance Accounting Standards Board, and a discussion paper came to light in 2009. The lease accounting standard then went for 2 exposure drafts until a final release was made in February of 2016. There has since been a 2-year implementation period by which organizations of all shapes and sizes have had the opportunity to both reflect and understand the implications from a financial reporting perspective. Traveling back to 2005, the Securities and Exchange Commission off-balance sheet report identified 3 primary deficiencies: transparency, comparability, and disclosure. SEC registrants were noted to have approximately $1.25 trillion in undiscounted cash flows that were associated with the off-balance sheet financing of operating leases. The report noted a current all-or-nothing approach to recognizing leases on the balance sheet. This resulted in the clustering of lease arrangements such that their terms do not approach nor cross the bright lines or the 4 criteria and the accounting guidance that would have required a liability under capital leases to be recognized on the balance sheet. Consequently, arrangements with similar economic outcomes were accounted for very differently. This prompted the right-of-use model under Accounting Standards Update Topic 842. The right-of-use model for lease accounting originated from the discussion paper of 2009. To understand the right-of-use model, FASB relied heavily on definitions related to lease accounting, and we turn to these now. First, we explore the definition of a lease. A lease is defined as a contractual obligation that allows an asset owned by one party to be used by another party for specified periods of time in return for payments for a series of payments. Next, we turn to the definition of an asset. According to FASB's conceptual framework, an asset is defined as the following: the entity controls an economic resource or benefit, and it arises out of a past event, and future economic benefits are expected to flow to the entity. As we take this definition and we compare it to the right of use in a lease, the board concluded that the lessee controls the right to use the leased property during the lease term, since the lessor does not have the right to recover or access the leased property without the consent of the lessee without falling into contract breach. In addition, the lease arrangement arises out of a past event because the lessee signed a contract and received the item in the following transaction. Finally, the leased property is expected to result in future economic benefits using the leased item. Therefore, the board concluded that the right-of-use asset exists, which constitutes an asset in accordance with FASB's conceptual framework. A liability, according to FASB's conceptual framework, is defined as the following: there are probable future sacrifices for economic benefit. They arise from the present obligation to either transfer assets or provide services to other entities and result from past transactions or events. As we take this definition and we explore it in relation to the liability embedded within a lease, the board identified 2 possible sources of liability. The first being the obligation to pay rental fees and of the obligation to return the leased asset at the end of the lease term. First, let's explore the definition of liability in relation to the obligation to pay the rental fee. Rental payments associated with the lease are an unconditional obligation and therefore represent an obligation to pay rental fees for the lease term. The obligation arises out of a past event resulting from the signing of a lease agreement. And finally, the rental payments result in an outflow of economic benefit via the cash payments. Next, we explore the definition of a liability applied to the obligation to return the leased item at the end of the lease term. First, a present obligation arises from the requirement of the lessee to return the leased item at the end of the lease term. Second, the obligation arises out of a past event from the original signing of the lease agreement. And third, the obligation to return the leased property at the end of the lease term does not constitute an outflow of economic benefit, as a lessee's right to use the leased property merely expires and has no right to the economic benefits associated with the asset after the expiration of the lease term. Due to this conclusion, the board concluded that the obligation to return the leased asset at the end of the term does not constitute a liability in accordance with the conceptual framework. Once the board identified what part of a lease transaction establish an asset and a liability, they continued to work to hone a new approach to account for leases. The board established that the current accounting model for leases was inconsistent with their findings of an asset and liability arising from lease transactions. Therefore, the new approach under ASU 842 set out to recognize assets and liabilities arising from lease transactions. The asset arising from the lease agreement was the right-of-use asset, and the liability arising from the lease agreement was the obligation to pay rental fees. Initially, the board thought a one-method approach over a two-method approach resulted from the right-of-use model. The right-of-use model mandates that all leases longer than 1 year be recorded on the balance sheet. The lessee records an asset for the part of the asset for which it controls the right-of-use asset and records the liability for the obligation to make payments over the lease term based on the present value of the minimum payments. The two models that resulted were the financing lease and the operating lease. Both leases, in contrast to prior treatment, are capitalized on the balance sheet. The balance sheet is the same in both. It's the expense recognition on the income statement that differs. In addition, there's a third, almost lesser-known model, which is also called the short-term lease. The short-term lease has no balance sheet impact. It's designated solely for a lease in which the term is less than 12 months and contains no purchase option. We should note that while this was a joint project between FASB and ISB, under IFRS, only the financing lease is in existence along with a small carve-out for the short-term lease. Next, we explore a summary of the financial statement impact. Under a finance lease, you would expect to see the right-of-use asset and the associated lease liability on the balance sheet. On the income statement, we'll note both amortization and interest expense. And on the statement of cash flows, there will be the cash paid for both principal and interest payments. Under the operating lease, again, we will see consistency in the right-of-use asset and lease liability on the balance sheet. On the income statement, we will see one single expense on a straight-line basis, and on the statement of cash flows, we will see cash paid for lease payments. Next, we'll go deeper into a finance lease before moving on to an operating lease and then ultimately a short-term lease. Under a finance lease, the economics are similar to that of an acquisition of an underlying asset. The criteria of a finance lease are as follows. The first is a transfer of ownership. The agreement must specify that ownership of the asset transfers to the lessee at the end of the lease term. We also deem that as a title transfer. The second is the purchase option test. The agreement contains a purchase option that the lessee is reasonably certain to exercise, also deemed a bargain purchase option. To the extent that this exists, this should be included in the calculation of minimum lease payments. Next is a lease term test. The lease term is for a major part of the economic life of the underlying asset. Fourth is the present value test. The present value of the lease payment equals or exceeds substantially all the fair value of the underlying asset. In the past, this was deemed at 90%. And finally, the alternative use test. The leased asset is of such a specialized nature that it would be expected to have no alternative use to the lessor at the end of the lease term. From a finance lease perspective, the lessee records the right-of-use asset and a lease liability at the beginning of the lease term. The lessee records interest using the effective interest method and amortizes the right-of-use asset on a straight-line basis over the lease term. Or, if ownership transfers or a bargain purchase option exists, then the asset should be amortized over the full useful life. Because the lease liability will decline each period, the amount of interest will also decrease.